Yay, there is zero transfer fee, there is zero brokerage. So does that mean if we from India, having an Indian passport, directly invest in the US with the US discount broker and buy, say, Microsoft shares, and after 10 days we sell the Microsoft shares, and there was no capital gain. The price at which we bought Microsoft share and the price at which we sold Microsoft share being equal, and we get back the money to India, then we would be able to get back the entire amount, right? Or is it? Assume you have just opened a first rate trading account in the US from India and you want to buy Microsoft shares with a budget of $1,000. But here's the challenge, you don't have a bank account in the US, and brokers like First Trade or any other US bank broker won't accept funds from third party services like Western Union. So that leaves you with only one legitimate route, a wire transfer. This means your Indian bank, say HDFC or ICICI, SBI, or whichever you use, will send your money through a SWIFT network directly to the First Trade's designated client pool account. Once you intimate First Trade with your transaction details, their back office allocates the funds into your trading account ready for you to buy Microsoft shares. The USD INR is 88.27. So if we plan to invest $1,000 in Microsoft, the funds needed would be 88,270 INR. The bank says zero transfer fee, full value credit. What charges they don't tell you is the exchange rate they will actually use or the wire transfer charges. So let's assume a $30 flat wire fee, which is quite possible in India, plus a 0.5% conversion spread. The usual spread is more than 0.5%, but conservatively it is 0.5% in India. This comes to roughly for $1,000 or $5. So overall, the $30 wire fee plus the $5 charges for the foreign exchange conversion spread, that means a $35 overhead is directly there at this point in time, even before we start moving funds into the First Trade pool account. The First Trade itself doesn't charge for incoming wires. But remember, not all US discount brokers need to adhere to this policy. Now assume Microsoft trades at, say, $400 per share. In the US, fractional shares are possible by some discount brokers, and so First Trade also allows it. So we have assumed that we have already requested First Trade for a fractional share purchase plan. So with $1,000 minus $35 of overhead, we can buy 2.41 shares of Microsoft. Let us assume that 10 days have passed. Now after 10 days, the Microsoft share price is assumed still $400, and the USD INR is more or less at, say, an exchange rate of 88.27. Now, assume we sell the 2.41 shares and we try and get the proceeds that are deposited in First Trade account back to India. To send the money back in India, we require a wire transfer. Every US broker will charge a flat outgoing wire fee. With First Trade, let's assume it is $30 for simplicity, because typically they charge $25. Now we notice that the First Trade brokerage for buying and selling of Microsoft shares without any profit in this case was less than 2 rupees in each leg. So basically, it is 4 rupees for this entire exercise. So we can ignore the 4 rupees as a round of error. Unlike India, they don't charge any AMC. Recall, we can look at the earlier video that describes how the discount brokers of India and the discount brokers of US, both claiming zero charges for stocks taken on delivery without margin, can be reviewed once again. So here is the math. Each leg of the transfer, India to First Trade and back again, cost us 3,089 rupees. So the total is 6,178. So this entire 6,178 is lost as overhead. So the result, even though Microsoft's price and the USD INR didn't move an inch, your round trip cost you nearly 7% in frictional expenses. And that is the real hidden cost of investing across the border. This 7% was lost in 10 days when the Microsoft share was stagnant and the USD INR was stagnant.
And that is today's learning. Zero transfer fee does not mean zero cost. As an investor from India, if we want to invest in the US directly, we not only have to calculate and make sure that the zero brokerage that is being claimed by the discount brokers are indeed zero, but we also should calculate the overhead of the round trip cost that is involved. This foreign exchange round trip is the real overhead. And sometimes, even if the markets don't move, both the stock market or the currency market in this case, where the USD and INR stay more or less at the same price range, still the money can move away from us. And the only way to plug it in is to come up with a solution that can help us prevent the leaks of foreign exchange overheads. So is there a solution for this at all? The answer is yes. There is a way to do it so that by more than 90% the overhead can be corrected. We will discuss this in our next video. Stay tuned.